Most people are familiar with the Apples and the Microsofts, and other large companies often global in scale. And although larger companies are generally safer to invest in, they may not represent the best value for your money when there's a bear market like right now. Because if we look at the S&P 500, which are made up of large cap stocks, their average forward PE ratio is 15.9, which as you can see is fairly decent. It's certainly come down from last year where it was over 20 times, but we're still not seeing really deep value. And if sentiment gets worse, we could see this PE ratio drop to like 14 or 13, like back in March of 2020, or even lower, like in 2011. However, if we look at small cap stocks, the forward PE ratio is only 11.3, which is much lower and therefore much more attractively valued. From a historical measure, we're pretty much scraping the bottom of the barrel here. It's already super rare for small cap companies to trade at 11 times forward earnings. But also, when they do come down, the valuations rarely stay at these levels. So this moment in time represents a really good opportunity to buy small cap stocks at extremely attractive valuations. And when we eventually get price to earnings expansion again, we should see a measurable rise in the investments that we make today. But how do you know which small cap stocks to choose? Because generally speaking, these businesses are riskier than mid cap or large cap stocks. Well, there are small cap index funds that you can invest in, which will give you exposure to this entire subgroup of the market. But if you want to choose individual companies, I'm going to be sharing 5 extremely undervalued small cap stocks today. And by the end of this video, you'll have a pretty good idea of what these companies do, how to value them, and whether or not you should add them onto your watch list. So let's start with the first one, Century Communities, ticker CCS. They design and construct homes for people to live in, and the stock is down 45% year to date. They are profitable and they've been growing pretty fast, especially over the last couple of years. According to TipRanks, this is a strong buy. In fact, all of the stocks that I'm going to be talking about today are strong buys. In this case, for Century Communities, the average target is about 51% higher than the current price of the stock, and even the lowest estimate is 23% above today's stock price. So if you buy this now, there is a chance you're going to make like 50% over the next 12 months. Now, often with small caps, the issue is that you don't have a lot of analysts covering the company. So in this case, there are only 3 analysts, which is not really a good enough sample size to put a lot of weight on this average price target. But what you can do is look at the financial ratios yourself and determine if it's cheap or not. So looking at the key ratios here, what I really like about this company and why I say it's really undervalued is because the PE ratio is just 2.84. But the 5-year average has been about 7.5. In fact, pretty much all the other metrics have dropped off a cliff as well. The price to sales is now just 0.31, which is super low, and the stock is trading at about 2.3 times its cash flow, which is again super cheap by any stock valuation comparison. Historically, the company has done very well. Here's the revenue growth. Each one of these blue bars represents 1 year, and you can see that looks like a pretty good growth rate. Earnings per share skyrocketed last year. So why is the PE ratio so low? Well, that's where we get into one potential risk with this stock, is that next year in 2023, earnings are expected to actually drop. If I go to analyst forecast, you can see after 2022, 23 is forecasted to have a lower earnings per share, and that's why this gray bar is lower than the previous one. Also down here for revenue, we can see that once this year is done, next year the company is expected to actually make less money. However, because interest rates are still going up, the forecast for 2023 and 24 could be even lower. So we might have 2 or 3 years of earnings and revenue below 2022 levels before we start seeing growth again in this company. And that's why this stock is being discounted a lot. So if you want to invest in what seems like a really cheap company, you need to have a longer time horizon compared to investing in a large cap stock like an Amazon or a Google, because small cap stocks are more volatile than large cap stocks. So you will need to have more patience in order to see the expected result of your investment strategy. So what that means for this one is don't buy a full position right away. I would dollar cost average into this and maybe spread out your DCA plan over the course of, like 2 or 3 years instead of 2 or 3 quarters. Because I think next year in 2023, the US housing market is going to be really bad. And there's a pretty big risk that stocks like CCS are going to get hit disproportionately hard compared to other stocks, even other small cap stocks. Another hint that it might take kind of long for the stock to bounce back is if we take a look at the PE ratio historically, the angle that this drops often matches the angle that it recovers. So in 2018, there was sort of this wide V shape drop and recovery. In 2020, there was a steeper, more narrow V shape where the stock dropped very quickly, but then it also bounced back really quickly. And now we have this situation where it's sort of just curved down and we're slowly kind of just scraping the bottom. So I think on the recovery up, it's not likely that we're going to see a big pop like in 2020, but rather it's likely we'll see a more gradual incline on the other side. So that's just something to keep in mind because companies surrounding the construction industry in general are quite cyclical. But what isn't cyclical is a stock like Addus, ticker ADUS. Addus Home Care provides services to seniors in their own homes, and they're adding more locations. This one is also a strong buy. The stock is trading at just under $100 in last Friday's after hours trading. The 1-year target estimate is 117, so that's a 17% upside that you're looking at. Here's a Morningstar report showing incredible revenue growth over the last 10 years, as well as earnings per share growth. And basically, this is a 5-star stock as long as it's below 104, which it is right now. So it's trading at a slight discount of 86, but the stock really goes below its fair value. You can see it did that last year, but in 2020, 2019, 2018, 17, we're all above fair value. So this is a stock that likes to trade at a premium most of the time. And it's only in certain cases you'll get a chance to buy it at around 80 cents on a fair value dollar. In terms of the analyst's forecast, there's not going to be a lot of slowdown over the next few years. We're going to see higher and higher earnings per share, as well as higher revenue over time in 23 and 24 as more people need in-home care and they don't want to or they're not ready to go to a retirement home yet. Now, if senior care doesn't float your boat, then maybe this next stock will. It's Malibu Boats, ticker MBUU. They make all kinds of boats. They have crossover and ski series, surf boats, and other things like that. And this company is down 31% year to date. As you can see, this most recent leg down has been pretty bad. They've been growing very quickly over the years, and because of the recent decline in their stock price, they are now trading at just 6.3 price to earnings ratio, which is a 5-year low. And if we look at the trailing PE, we can see that it's pretty much at the same PE ratio as March of 2020. So similar to the price of the stock, we can say there is support down here around the 6 times earnings level. It doesn't mean the ratio can't fall below this point, but at some time in the future, I would expect this PE ratio to get back to a normal range of, say, 12 to 20%. If we look at the ROIC website, we can see information for revenue, which is growing very nicely. But the other thing we can see is the historical PE ratio. Other than 2014, which is an anomaly, if we look at 2015 to now, basically, it's pretty obvious that this current PE ratio is probably not going to stay this low. So either the earnings have to drop by quite a lot in order for the PE ratio to get back to, let's say, the mid-teens range, like in previous years. Or if the earnings stay the same and the PE ratio doubles, then you basically have a doubling of your stock. So let's take a look at what analysts say. And once again, this is a strong buy stock with a handful of analysts here. And the lowest price target looks like is $50, which is above today's current stock price. So if the most bearish analyst is correct, you're going to make 4.5% after a year. And if the most bullish analyst is correct, you'll almost double your money. And then, of course, the middle being a 50% return, which is still pretty good. The only thing to watch out for when it comes to this stock is, of course, this is a discretionary expense for a lot of people. If consumers are finding it hard to make ends meet, then they're not going to go out and buy a sports boat. So I think that's the main reason for the PE compression. Supply chain issues are a problem for this company because it might take them longer to source all the parts and build the boat. And then in some cases, their customers would rather just buy like a competitor's boat that's already built and they can get that delivered delivered pretty soon rather than wait like half a year to get a Malibu boat. It's kind of like cars. If someone wants to buy a vehicle that's available but maybe not in the exact color that they want, maybe that's better than opting for a more customized car, but you'll have to wait a long time to take possession of it. But the thing is, after this recession is over, I would expect Malibu boats to continue growing at double digits. So 2 to 3 years from now, this could easily be a $100 stock. And speaking of vehicles, let's move on to the next one, ArcBest, ticker ARCB. And this is a logistics company that moves things around using trucks. So if you need something moved across the country, that's what this company does. Valuation-wise, they are not expensive, trading at about 10 times PE right now, which is lower than their 5-year average. Financials are pretty decent, either flat or growing over the last 5 years. And if we take a look at the analyst ratings, we see that it is a strong buy with a 45.6% upside. So the current stock is $73, and the average price target is 107, meaning the stock is currently undervalued by about 33% or so. Now, the issue with this stock is similar to Century Communities. Pretty much everyone is expecting the US to be in a recession in 2023, so earnings are expected to actually fall quite a bit. The average estimate is 11.86 earnings per share, and that's going down from 14.13, so that's quite a big drop. And of course, that's only the average estimate. So in reality, it could be a lot worse if people are really pulling back on their spending. So ArcBest is trading at a very attractive valuation compared to where it's been historically. But if the economy slows down, we could see this PE ratio drop more and the stock price can go lower, even though it does look underpriced right now. According to this Morningstar report, ArcB is undervalued by 36%. And 36% is quite a large discount. In fact, that's the most undervalued it's been over the last 10 years. If you look at the price to fair value metric here, 0.64, it's the lowest, with 2012 being the second low at 0.69. And then the last stock is SMTC Semtech Corp, which is a smaller tech company in the semiconductor space. Similar to other hardware chip makers, this company is down a lot this year, dropping 70% since the beginning of 2022. And even though the stock is undervalued, I would be careful, again, buying a full position of this. I would start with dollar cost averaging and not really get aggressive until this slope turns the other way and starts going up, because right now it's clearly not a bullish trend. But in terms of the valuations, it's really starting to look good right now. The average price target is 5150, which is 93% higher than today's current price. And the most pessimistic analyst gives this a price target of $34. So you're going to get a 27% upside if that bearish price target comes true, which is still a pretty good return. If we look at the key ratios, we can see that the PE ratio has come down a lot. Can it go down further? Yes, but this is already at fairly cheap valuations. It's trading at less than 9 times cash flow, whereas over the last 5 years, the average has been 33. The biggest risk to this company is probably just stagnating earnings moving forward. If we take a look at the forecast for the next few years, the earnings per share isn't really growing out to 2025. And the revenue isn't growing either. It's pretty much just flat for the next 3 years. So if that's the case, then you might get a little bit of value from PE expansion, but otherwise not as much as other companies that are actually growing their top and bottom lines. So there you have it, 5 small cap, extremely undervalued companies for you to consider adding to your watch list. According to analysts, these all have strong buy recommendations. But of course, you have to do your own research to find out if they are the right stocks for you. We don't know if this is the bottom of the stock market, which is why any money you put into the market right now, especially if you're buying small cap stocks, you should plan to stay invested for at least a couple of years. But of course, the longer the better, because after 5 or more years, your chance of making a huge profit are going to be much higher, assuming you pick high quality stocks. Small caps have come down a lot more than large caps, but what that probably means is on the way back up, small caps are likely to outperform the large cap stocks. And that's why smaller companies are considered better value today. Now, if you'd rather stick with the relatively safer large cap stocks, I made a video last week talking about the top 5 stocks that the most successful investors are buying this year. So if you haven't seen that yet, you can take a look at that. Thanks a lot for watching. As always, good luck with your investments, and until next time.